Thanks for watching another video from NetPicks, and today we're going to talk about using the ATR, the average true range, for stop loss placements. And frankly, I think it's a pretty smart way to determine where your stop loss should be placed on the chart, and it's something that I use all the time on every trade I take. Sure, there are other ways that we can set stops. We can use support and resistance levels, whatever those are to you. Candlestick swing highs and lows, trend lines, whatever. The ATR uses volatility. Because price volatility can often make your trading pretty difficult. Prices whipping back and forth, and it's pretty easy for a stop to be taken out during erratic swings when market conditions are pretty tough to trade. And we've all seen it. We've all had instances where our stop will get ticked out and then head on to the profit target. And it's pretty hard to watch when you have a solid risk to reward trade and it breaks down because you decide to keep a really tight stop loss. And a lot of people do that to increase their position sizing, or they have a small trading account. But if we use the ATR, we can actually take advantage of the range of price over a set period of time, and then we just average it out. And I actually have this video up here where you can learn how to use the ATR. Two other ways in your trading. Check that out when you have time. So when we talk about ATR, we got to talk about the multiples. And we're looking at 2 times, 3 times, 4 times, whatever. And this is where you decide your risk tolerance and the markets that you're going to be trading, of course. So if the market that I'm trading has large swings, I may use a larger multiple from 3 to 6. A quiet market, I might use 1.5 to 2.5 as my multiplier. Okay, there's never going to be a perfect number at all when you are using it. So for example, this is a 14 period ATR. And in this case here on this chart, the current ATR value is $8.77. Okay, what that means is the average range of price movement up and down is $8.77 over the last 14 periods. And using that multiple, it's pretty simple. We got 877 times 1, 877 times 2, 877 times 3. So all this means is that from a point that you decide, you would add or subtract any of those amounts from the price. Now, one thing to keep in mind that the correct ATR reading will not be known until the closing price of that candlestick. So depending on how you trade, you may have to use the previous candle's reading. So here's a little stop loss strategy you can use. So I want you to imagine that your strategy has you entering momentum on the candlestick at its close here. So your entry price is $402.70. And you've chosen to use 2 times the ATR value to place your stop loss. So you calculate the stop loss location of 402.7. That's your entry price. 877 times 2, because you're using a 2 times the ATR multiple. That is $402.70 minus $17.54. That's the ATR. So your location for your stop would be at $385.16. So let's stay with our current example here. If price moves 2 times the average true range to the downside, this trading strategy would determine that it's a big move and you would be out of this trade. Let's look at a different example here. This is going to be a day trading stock chart. And in this strategy, I want you to imagine that you play pullbacks after a breakout of highs. So the price breaks out of highs. You set a limit order to go long at $74.28 when market pulls back. So since you're using a limit order, you have to use the last printed candlestick, that ATR reading, and that's where the red arrow is. So for this example, you're going to set the stop loss at 1 times the ATR. That's 19 cents. So you take $74.28, which would be your entry price. And you would minus the 19 cents ATR. Your stop loss would be right there at $74.09. Now here, your trade takes a little bit of heat, but you do manage to ride a momentum move to the upside. So one question you have to answer is where you're going to calculate your stop loss location from. So will you use the high price of a bar minus the ATR? Will you calculate the closing price minus the ATR? Or you'll use the low price minus the ATR value. Is there a difference? Well, there is, depending on the candlestick that you enter your trade on. So in this stock chart again, it's a day trading strategy. Pull back after a breakout. You buy stop the high of the candle that pulled into your trading zone. That's the green. You set the stop 1 ATR from the high of the setup candlestick and you enter the trade. Now notice that large candle there almost pops you from the trade before roaring into profit. So if you just put your stop below low, you got ticked out. But from here, from the low or the closing price of the setup candle, you're far enough away to keep you from butting your nails on this trade. But now we got to deal with another issue, and it's position sizing. Because your stop loss will also depend on the risk parameters for each trade and your overall account size. So if we go back to the last chart, let's see what risk we're looking at. So where you calculate your stop from is going to depend on how you look at this range here. So if you're using your entry price and any ATR multiple from that price, invalidate your trade. Is that how you're going to do it? If you're long, do you consider the takeout of lows an indication of your trade failing? Now, if your entry is somewhere in the middle of the candlestick, do you consider the high part of your range? So using this chart with 1 times the ATR, that first stop is from the high, and you're using a breakout for an entry, and any adverse price action from the highs would invalidate your trade, so the range. The second stop, you use the breakout, but you want the trade to have a little more room to breathe, so you pay higher for the insurance. Okay? See that one's from the high, one is calculated from the low, and the close. It's personal preference, and it's really limited by your trading account size. Now, what about trailing stops? Now, letting profits run while respecting the volatility of the market, it's popular. Now, the ATR can keep your stop further away from volatile price action and a little bit closer when the price action is smoother. So why is that important? Well, during smooth price action, any large move against your position is going to point to a change in the market. So you don't want to be holding long, when momentum shifts to the downside against you. Trailing your stop loss, an ATR, so an average range distance from current price, it's a pretty objective means to manage your trade. It takes emotions out of it. So in this example, we're going to use 2 times the ATR, okay? And we're going to set the ATR calculated from the high, the low, and the close. Now the entry candle, the black arrow there, that's just an example. So I want you to keep in mind that even though the third candle from the left touches the line, the black line, right? That's where our stop is calculated from highs. You would not exit the trade because that particular price for the line, the ATR line, that's not set until that candlestick closes. Okay, so you don't get ticked out of that trade. Now you can see the various locations that you're going to be taking out of the trade. The red line is actually where it's the low price minus the ATR. That may or may not have been filled at that location. Okay, if not, you would actually have been taken out 1.5% higher on this chart. This is crude oil futures, so you may not have gotten taken out on that trade. Whatever you use, really, the key is just to be consistent in your trading approach. And you also want to make sure you never just move the stop further away from position when price is coming close to your stop. Personally, I love using ATR, and I think it's a pretty viable approach to managing your trades, protecting your trades. Thanks for watching.